Welcome to the Deep Dive. We cut through the noise to get you the knowledge you need, fast.
Glad to be here.
So today we're diving into something a lot of business owners or investors might hit. You start a venture, maybe an LLC, an S-Corp.
Right, full of excitement.
Exactly. And then maybe things don't go perfectly. You have a loss. The big question is, what happens then? Can you actually deduct that loss on your taxes? How much?
That is precisely the puzzle we're putting together today. We're focused on what the tax world calls loss limitations.
Loss limitations, okay.
Think of them like 4 hurdles, or maybe gates. You, as an individual taxpayer, have to clear these hurdles in sequence to deduct a business loss.
4 hurdles sounds like a process.
It is. And we're going to walk through each one step by step. Our goal is to make this, well, kind of complex area feel much clearer, much more actionable for you.
So the mission today is really to give you that solid foundation. Understand the rules, see how they connect, and know what it means for your bottom line.
Exactly. It's about decoding this part of the tax code so you feel, confident and informed. No more guessing.
All right, let's jump in. Where do we start with these 4 hurdles?
Okay. So the key thing to remember is that these 4 limitations, they apply one after the other. It's a sequence.
Not just pick and choose.
No, definitely not. You have to clear them in order. First up is the tax basis limitation.
Okay.
Then comes the at-risk limitation.
Hurdle 2.
Right. Now, these first 2, tax basis and at-risk, they generally apply at the level of the business entity itself, if it's a flow-through like a partnership or S-Corp. They basically determine how much loss can even get out of the entity to the owners.
Ah, okay, so they're like initial filters at the business level before the loss even hits my personal return.
That's a great way to put it. Filters. If a loss makes it through those first 2 filters, then it faces the next 2 hurdles on your individual tax return.
Which are?
Number 3 is the passive activity loss limitation, usually called the PAL limitation.
PAL.
And the final one, number 4, is the excess business loss limitation.
Okay, tax basis, at risk, PAL, and excess business loss. In that order, let's tackle hurdle number 1. Tax basis. What exactly is tax basis?
Think of tax basis as your financial stake in the ownership interest. It starts with what you put in cash, property.
Your initial investment.
Right. Then it gets adjusted over time. It goes up with income the business earns that flows through to you. Sometimes your share of business debt can increase it too.
And it goes down.
It goes down for deductions, losses that flow through, and any distributions the business pays out to you. So it's kind of like your running tally of investment.
And the rule is I can only deduct losses up to that basis amount.
Exactly. Your basis acts as a ceiling for the loss you can deduct in any given year.
So what if my share of the loss is, say, $50,000, but my basis is only $30,000? What happens to that extra $20,000?
That extra $20,000 loss, the part that exceeds your basis, it's not deductible right now. It gets suspended.
Suspended. Just hangs out somewhere.
Pretty much. It's carried forward indefinitely. You can use it in a future year if and when you get more basis, maybe you invest more money, or the company makes a profit that increases your basis.
Okay, carry forward. But what if?
Yeah.
What if I sell my interest in the business while I still have these suspended basis losses? Do I get to use them then?
This is the really crucial part about tax basis suspended losses. If you dispose of your interest, sell it, give it away, whatever, and you still have losses suspended because of basis, those losses are gone.
Gone, like disappear forever.
Lost forever. They just vanish into thin air. You don't get to use them against the sale price or anything else.
Yeah. Okay, that's harsh. Lost forever. Good to know. And this applies across the board.
Yes. The basis limitation applies to all activities. Doesn't matter how involved you are.
All right, so if a loss makes it past the basis hurdle, it immediately faces hurdle number 2, the at-risk limitation. Sounds similar, but different.
It is similar, but focuses specifically on your economic risk. How much do you personally stand to lose?
My actual skin in the game.
Exactly. Your at-risk amount often starts out the same as your basis, but there's a major difference when it comes to certain kinds of debt.
Okay.
The at-risk rules generally exclude your share of any non-recourse debt.
Non-recourse debt. Can you break that down simply?
Sure. Non-recourse means you personally are not on the hook to repay that debt. If the business defaults, the lender can take the property that secures the loan, like a building, but they generally can't come after your personal bank account or other assets.
Okay. So because I'm not personally liable, I'm not considered at risk for that amount of debt.
That's the idea. There's an exception for something called qualified non-recourse financing, which is usually specific types of real estate mortgages from commercial lenders, but the general rule excludes standard non-recourse debt from your at-risk amount.
So the rule here is I can only deduct losses up to the amount I'm actually at risk for.
Correct. Losses beyond your at-risk amount, they also get suspended and carried forward indefinitely, waiting for you to increase your at-risk amount.
Okay, sounds like the basis rule again.
Mm.
But you said there was a difference,
Yeah.
especially when selling.
Yes, and it's a big one. Remember how basis losses disappear if you sell with them still suspended?
Yeah, lost forever. Still
Yeah.
processing that.
Well, with suspended at-risk losses, if you sell your interest, you can use those suspended losses to offset any gain you make on the sale.
Ah, so they don't just vanish. They can actually help reduce the tax on my profit from selling.
Exactly. It's a really important distinction between the two limitations.
That is a big difference. And the at-risk rules, they also apply to all types of activities.
Yes, just like tax basis, the at-risk rules apply regardless of your level of participation in the activity.
Okay, hurdle 1 and 2 cleared. Basis and at risk. Now, the loss reaches my personal return and hits hurdle 3, the passive activity loss, or PL limitation. This sounds like it's about classifying things.
You got it. The PL rules force you to categorize all your income and losses into one of 3 buckets.
3 buckets, what are they?
First, you've got active income or loss. Think salaries, wages, guaranteed payments for services, or income from a business you materially participate in.
Materially participate. We'll need to define that. What's the second bucket?
Second is passive. This is income or loss from a business where you don't materially participate. The classic example is rental real estate. It's automatically passive unless you meet a specific exception. Also, being a limited partner in a partnership usually means that income or loss is passive.
Okay, active and passive. And the third?
The third bucket is portfolio income. This is your typical investment income interest, dividends, royalties, annuities, capital gains, and losses.
Got it. Active, passive, portfolio. Now back to material participation. That sounds key for distinguishing active from passive. What does it mean?
It means your involvement in the business operations is regular, continuous, and substantial. There are actually several tests, but the most common one people look at is, did you spend more than 500 hours working in that activity during the tax year?
500 hours. That's a pretty clear benchmark.
It is. There are other tests too, like if you do substantially all the work, or more than 100 hours and more than anyone else, but the 500-hour test is a common go-to.
Okay, so once everything's sorted into active, passive, or portfolio,
Yeah.
what's the main PAL rule?
The core rule is simple but strict. Passive activity losses can only be used to offset passive activity income.
Only passive income. Not my salary, not my dividends.
Nope. Can't use payouts to reduce your active income or your portfolio income. If you have multiple passive activities and some make money while others lose money, you net them together.
What if I have more passive losses than passive income in a year? A net PL.
That net PL is, you guessed it, suspended.
Another suspended loss.
Yep. It gets carried forward indefinitely, waiting to offset future passive income.
But is there a light at the end of the tunnel for these PLs, like when I sell the activity?
Yes, absolutely. This is the big release valve for PLs. When you completely dispose of your entire interest in that specific passive activity.
The whole thing.
The whole thing.
Yeah.
Any suspended PLs tied to that activity are fully released. They become deductible against any type of income in that year, active, passive portfolio. Doesn't matter.
Wow. Okay, so selling unlocks those losses to offset anything? That's huge.
It really is. It's a major planning point when thinking about exiting an investment.
Now, you mentioned exceptions for rental real estate under the PL rules. What were those again?
Right, 2 main ones. First is offering that mom and pop exception.
Okay.
If you actively participate in your rental real estate, which is a less strict standard than material participation, involves things like making management decisions, and you own at least 10%, you might be able to deduct up to $25,000 of your net rental losses against your non-passive income, like wages.
$25,000 against wages. That sounds useful for smaller landlords.
It can be, but there's an income limit. That $25,000 deduction starts to phase out if your adjusted gross income, AGI, goes over $100,000, and it disappears completely once your AGI hits $150,000.
Ah, okay. So it's targeted. What's the other exception?
The other one is for real estate professionals. If you qualify under the tax rules as a real estate professional,
Which means?
it means 2 things have to be true. 1, more than half of the personal services you perform all year are in real property trades or businesses. And 2, you spend more than 750 hours during the year working in those real estate businesses.
That sounds like a serious commitment to real estate.
It is. But if you meet both tests, your rental real estate activities are generally treated as non-passive or active. The PL limits just don't apply to those rental losses. You can potentially deduct them against your other income, assuming you clear the basis and at-risk hurdles.
Big advantage if you qualify. Okay, so let's say our loss made it through basis, at risk, and the PL rules. Maybe we had passive income to offset it, or we sold the activity. Now we hit the final hurdle. Number 4, the excess business loss limitation.
That's the last gatekeeper. This one applies after everything else, including the PL rules.
And what's its job?
Its job is to put an overall cap on the total amount of net business losses an individual taxpayer can deduct in a single year.
An overall cap. How does it work?
You basically add up all your business income and gains and subtract all your business deductions and losses from all your businesses. Doesn't matter if they're active or passive for this calculation. If the total deductions exceed the total income by more than a certain threshold amount,
Then you have an excess business loss.
exactly, and you can't deduct that excess portion in the current year.
What are those threshold amounts?
They're indexed for inflation, but for 2023, the threshold was $578,000 for married couples filing jointly, and half that, $289,000 for all other taxpayers, single, head of household, etc.
So if my net business loss for the year is, say, $300,000,
Yeah.
and I'm single, I could deduct $289,000.
Right.
But the extra $11,000, $300K, $289K, is disallowed. What happens to that $11,000?
That disallowed excess business loss gets carried forward to the next tax year, but it changes character. It becomes part of your net operating loss, or NOL carry forward.
An NOL. And that has its own rules for deduction later.
It does. Usually, NOLs carried forward can only offset up to 80% of your taxable income in those future years.
Okay, so this is truly the final check on large overall business losses for the year.
Precisely. It applies across the board to all business activities combined.
Wow. Okay, that's a lot to take in. Let's make this concrete with some examples. Let's bring back Michael. First, just classifying his income. He had $75K wages, $6K from Morrison Stubbs, partnership, passive, $3K capital gains, $12K dividends.
Right. So the 75K wages, that's clearly active income. He worked for it.
Makes sense. The $6K from Morrison Stubbs.
You mentioned he doesn't materially participate, so that $6,000 is passive income.
Okay, and the capital gains and dividends.
Those fall squarely into the portfolio income bucket, 3K and 12K respectively.
Perfect. Easy enough to classify.
Okay.
Now for the main event. Michael also has a $40,000 loss flowing through from another investment, M. Green & Sons. It's passive for him. His tax basis is $30,000, and his at-risk amount is $25,000. Let's walk this $40K loss through the hurdles.
Okay, let's do it. Hurdle 1, tax basis. The loss is $40,000, but his basis is only $30,000.
So right off the bat, $10,000 of the loss, 40K, 30K is stuck.
Correct. $10,000 is suspended due to insufficient tax basis. We carry forward $30,000 of the loss to the next hurdle.
Hurdle 2, at risk. We have $30,000 of loss left, but his at-risk amount is only $25,000.
Right. So now another $5,000, 30K, 25K, gets suspended. This time it's suspended due to the at-risk rules. That leaves $25,000 of the loss still potentially deductible.
Okay, $10 suspended for basis, $5 for at-risk. Now we take the remaining $25K loss to hurdle 3, PL limitation. M. Green & Sons is passive. Does he have passive income?
Yes, remember that $6,000 of passive income from Morrison Stubbs?
Right, so he can use some of this loss.
He can. He can use $6,000 of the $25,000 passive loss to offset that $6,000 of passive income. They cancel each other out.
Okay, $6,000 is used. What about the rest of the $25,000 loss? That's $19,000 left.
That remaining $19,000, 25K, 6K, is a net passive activity loss. It gets suspended under the PL rules, carried forward.
So after all that, how much of the original $40,000 loss did Michael actually get to deduct this year?
Only the $6,000 that offset his passive income.
Just $6,000. And the rest is suspended in different buckets. $10K basis, $5K at risk, $19K PAL.
Exactly. You see how the hurdles progressively limit the deductible amount?
And what about hurdle 4, the excess business loss limit?
Well, since only $6,000 actually made it through the first 3 hurdles to be potentially deductible.
It's way below the $289,000 threshold for a single filer.
Right. So the excess business loss limitation doesn't even come into play here. No impact.
That example really shows the sequence perfectly. Now let's jump forward. Michael sells his M. Green & Sons interest for a $20,000 gain. What happens to those suspended losses? The $10K basis, $5K at risk, and $19K PAL.
Okay, this is where the different rules on disposition matter hugely. First, that $10,000 suspended tax basis loss.
Uh-oh, is this the loss for everyone?
It is, because he disposed of the interest without having restored basis. That $10,000 just vanishes.
Oof, ouch. Okay, what about the $5,000 suspended at-risk loss?
That one he can use. It can be deducted against the $20,000 gain he recognized on the sale, so it reduces his taxable gain.
Good, little relief there.
Mm-hmm.
And the big one, the $19,000 suspended PL.
That $19,000 PL is now fully released because he disposed of the entire activity. It becomes deductible against any of his income in the year of sale.
Any income. So against the remaining gain, against his wages, his portfolio income.
Yeah, all of it, whatever he needs to offset. It's a significant benefit when you finally sell a passive activity with built-up PLs.
Really highlights the importance of tracking those suspended losses properly. Okay, let's try Rachel's LLC example with the rental property. $100 K cash, $20 K recourse debt she guaranteed, $30 K non-recourse debt, $50 K loss, passive activity. How does debt affect her basis and at risk?
Okay. For tax basis, we generally include the partner share of all partnership debt, recourse, and non-recourse. So Rachel's basis is her $100 K cash plus $20 K recourse plus $30 non-recourse. It equals $150,000.
150K basis, plenty to cover the 50K loss there. Now, at risk.
For at-risk, we only include the cash she put in and debt she's personally liable for. That's the recourse debt. The non-recourse debt is out. So her at-risk amount is $100 K cash plus $20K recourse equals $120,000.
120K and at risk.
Yeah.
Also, plenty to cover the $50 K loss. So she clears hurdles 1 and 2.
Easily. The $50 K loss flows through, but now it hits hurdle 3. PL rules. It's a passive rental loss, and let's assume she has no other passive income.
Then she can't deduct any of it.
Correct. Because passive losses only offset passive income, and she has none, the entire $50,000 loss is suspended as a PL.
Even though she had basis and was at risk.
Yes. The PL rules operate independently, and since the loss was fully suspended by PL, the fourth hurdle, excess business loss, isn't relevant here either. Nothing got through to be potentially limited by that overall cap.
Fascinating how one rule can stop the loss, even if others allow it. One last complex one. Michael sells M. Green & Sons, but this time he has a huge cumulative suspended PL of $350,000 released. He also has $20K passive income, Morris and Stubbs, $80K wages, $400K gambling winnings. How does the excess business loss rule handle that massive release PL?
Great question. When that $350,000 PAL is released upon disposition, it's treated as a non-passive loss for that year, so it can potentially offset his other income.
Okay.
However, because it originated as a business loss, it still gets factored into the excess business loss calculation for the year.
So it doesn't get a totally free pass just because it was released.
No, we need to calculate his net business loss first. He has $20,000 of business income from Morris and Stubbs, and now this $350,000 non-passive business loss from M. Green & Sons. Net that out.
That's a $330,000 net business loss for the year, $20K income, $350K loss.
Right. Now compare that $330,000 loss to his excess business loss threshold. He's single, so the threshold is $289,000.
His loss, $330K, is bigger than the threshold, $289K.
It is. So he can deduct the business loss up to the threshold amount against his other non-business income.
How much can you deduct in total then?
Well, first, the $350K loss automatically offsets the $20K Morris and Stubbs income. That uses $20K. Then he can deduct an additional $289,000, the threshold amount, against his wages and gambling winnings.
So $20,000 plus $289,000, that's $309,000 he gets to deduct this year.
Correct. $309,000 deducted.
But the original release loss was $350,000. What happens to the difference? $350,000 minus $309,000 is $41,000.
That remaining $41,000 is the excess business loss. It's disallowed for this year and carries forward as a net operating loss, NOL, to future years.
Subject to those NOL limitations like the 80% income offset rule.
Exactly. So even a fully released PLL can still get partially deferred if it creates a large enough overall business loss in the year of disposition.
Man, these layers really interact in complex ways. It'd be good to quickly recap what happens to each type of suspended loss again.
Good idea. So quickly, tax basis suspended losses. Carry forward. But if you sell before using them, lost forever.
The disappearing act.
Right. At-risk suspended losses. Carried forward. If you sell, you can use them to offset gain on the sale.
Helpful on exit.
Definitely. Passive activity losses, PLLs, carried forward to offset future passive income. If you sell the whole activity, fully deductible against any income that year, but still subject to
The excess business loss limit.
You got it. And finally, excess business losses. Carried forward as an NOL, generally subject to the 80% of future taxable income limitation.
That's a fantastic summary. So we've journeyed through these four crucial hurdles: tax basis, at risk, PAL, and excess business loss that determine how much business loss you, as an individual, can actually deduct.
And hopefully seeing how they work sequentially, how they interact, makes this less intimidating. It's really about understanding the flow.
Absolutely. Knowing these rules isn't just for your accountant. It gives you valuable insight for making investment decisions, structuring deals, and just understanding your own financial picture better.
It really empowers you to think strategically about things like, should I guarantee this debt? How involved do I need to be in this business? It matters.
Which leads to a final thought for you, our listener. How might digging into the nuances really understanding recourse versus non-recourse debt, or what truly constitutes material participation versus just active participation in a rental? How might that change your approach? What seemingly small detail, if you grasp it fully, could unlock a significant financial advantage for you down the road? Something to think about.